What up? Welcome back to book club. Today we are starting chapter 7. Okay, so today we're starting chapter 7, special bars and early warning system. All right, so in this chapter we're focusing on keying in on market psychology and simple bar combinations, comprehending common and uncommon bars, getting the lowdown on gaps, and understanding the significance of high-low range. All right, so let's jump in. All right, the price bar is the basic building block of technical analysis. Bar configurations come in endless combinations and permutations, but you can't possibly memorize them all. But knowing about the special bars is useful because they can be powerful predictors and everyone knows it. Special bars are a small series of 2 to 5 bars called combinations or configurations that stand out on a chart. You can see them immediately and so can everyone else. Most special bars and configurations are either trend confirmation or trend reversal patterns, but even when they're ambiguous, you still need to sit up and take notice. This chapter takes a closer look at these special bars and explains what you need to know. Okay, so finding clues to trader sentiment. You use price bar combinations to determine whether your security is starting a trend, staying on a trend, or losing its grip on the trend. The start of a new trend is sometimes the end of an old one, called a reversal. Keep reading to find out about more clues. I'm trying to figure out how I want to hold this book. Tick and bar placement. In any set of bars that describes an up move or down move, a bar or two may be a little out of line without ruining your interpretation, as I describe in chapter 6. And then sometimes you see bars that really stand out. It takes almost no practice at all to differentiate ordinary out-of-line bars from special configurations that traders consider to be associated with specific interpretations. In a series of 3 bars, each having 4 components, you can get any one of 2,463 permutations of configuration. When you specify joint conditions such as higher high together with higher low, the number of combinations reaches into the millions, and that's just with 3 bars. So when you see special cases, you know that you've gotten a valuable clue to upcoming price behavior. Even so, the interpretation guidelines aren't right all the time. In fact, nobody can tell you even roughly what percentage of the time the standard interpretation is correct, because it may be correct all the time in one security, but only 30% of the time in another, or correct 75% of time in one year, but only 50% in another in the same security. This inconsistency is probably why some technical analysts get very fussy about defining special bar configurations. They'll argue passionately that their definition of a key reversal bar is the only right one, or their idea about gaps is the only way to look at gaps. Don't let such differences of opinion get under your skin. What matters is your ability to spot a special bar configurations on your chart and strive to make the deductions about what they mean for your trading purposes. A bar component, or the placement of the entire bar, can be a function of noise. After discounting noise, remember that each security has bar configuration habits that reflect the trading habits of the crowd that trades it. Some securities are prone by hysteria, resulting in gaps, such as the Commodity Research Bureau Commodities Index, and others are beset by indecision, leading to inside days, such as the Japanese yen and Swiss franc. Refer to the following section, identifying common special bars, for definitions of these special bars. Trading range. In every instance of special bars in this chapter, the size of the daily high-low range is a key factor. The daily trading range is the difference between the high and the low of the day. You can also say that the range defines the emotional extremes of the day. If you have a bar with a small range and a sea of larger bars, the market is indecisive. Indecisiveness isn't the same thing as indifference. Indecisiveness can be dangerous. Nobody wanted to buy at a higher high, so perhaps buyers are getting tired of that security at current prices. A change in sentiment may be brewing, such as a deceleration and a price rise that precedes the end of the trend. When it's one very large bar in a sea of smaller ones, pay attention. Something happened. Traders are willing to pay a lot more for a rising security or they want to dump a falling one so badly that they'll accept an abnormally low price. Identifying common special bars. Special bars usually mean the same thing, and therefore you can focus on a few of the special bars with confidence in their reliability. In this section, you can get a feel for the common special bars as shown in figure 7-1. So those are common special bars. All right, so closing on a high note. It's bullish when the price closes at the high over several days. A series of closes at the high and its downtrending counterpart closes at the low indicates that the existing trend is likely to continue. In figure 7-1 that you just saw, configuration A illustrates closes at the high for 3 days running, and the third bar is much larger than the others, which means the high-low range is wider than the previous 2 days. So what's up? The first two bars show the close at the high at about the same level. On the second bar, the low of the day was lower than the low of the day before, meaning that sellers came out of the woodwork, but the bulls fought back, buying more and more so that the close was still at the high, trumping the lower low. Day 3 delivers a whopping gain and a third close at the high. But now you may be ready to bet the ranch on this configuration. Your instincts are right, with one word of caution. A big gain is often followed by profit taking by active traders. 3 days isn't enough to call this configuration a trend, so traders call it a move. It doesn't matter whether the closes at high occur at the start of a trend or while the trend is in progress. A fat gain always inspires some traders to take profit. Profit taking doesn't change a trend, but it can dent performance the next day. You can use your imagination or turn the book upside down to envision the parallel configuration on configuration A of figure 7-1, closes at the low. As you may expect, a series of closes at the low imply that a downtrend is forming or worsening. Spending the day inside. Configuration B in figure 7-1 shows the inside day. An inside day refers to a price bar in which the high is lower than the previous day's high, and the low is higher than the previous day's low. In other words, today's high-low range is inside the previous day's high-low range. It reflects indecision. Buyers didn't feel strongly enough about the security to buy more. Sellers weren't particularly inspired to sell either. The inside day doesn't suggest what's going to happen the following day, but does warn that the market is starting to reconsider what it feels about this security. Some commentators opine that an inside day is always a continuation bar. If you had an uptrend and it's punctuated by an inside day, don't worry about it. Your trend is safe. This opinion isn't borne out by statistical work, which finds an inside day leads to continuation only about half the time over tens of thousands of tests. You may also hear that it's not the next day after an inside day to watch. It's the second day after the inside day. Bottom line, you may not know immediately what an inside day means when you spot one, but you do know to keep an eye peeled. So getting outside for the day. Configuration C in figure 7-1 is the outside day, meaning the high-low range of the bar is outside the range of the preceding bar. The open and close ticks can appear anywhere on the outside day bar, but two variations stand out. One, the open is at a low and the close is at the high. The configuration suggests that something new has happened to inspire bullish buying right up to the end of the day. Number two, the open is at the high and closes at the low. You can deduce the opposite supply-demand setup here. Sentiment turned bearish and sellers overwhelm buyers right to the end of the day. The sheer size of an outside day bar gets your attention, but it doesn't mean much on its own. You also need to consider the placement of the open and the close and the configuration of the preceding bar. If the price series is untrended, the outside day alerts you to a possible trend beginning. If a trend is in place, the placement of the close relative to the open may be a hint of an up move or down move, but not always. Finding the close at the open. All right, so configure D in figure 7-1 shows a series of bars where the close is at or near the open. As you can guess, a close at or near the open reflects indecision amongst market participants. Trader opinion is divided as to whether this bar generally signifies a continuation or reversal pattern. Consider it a clue to look at what else is going on, such as trading volume. In candlestick charting, the open at or near the close is named a doji, a term I promise you'll come to use with ease. All right, so decoding spikes. While the inside day and the outside day in figure 7-1 have high-low ranges noticeably different from the preceding bars, they don't make your hair stand on end. Sometimes, though, the market delivers an exceptionally big bar with a widely out-of-whack high or low. Figure 7-2 shows two of these uncommon price bars called spikes. A spike is a bar that encompasses a much wider high-low range than the bars that immediately precede it. Do spikes matter? Yes, a spike is often the hairbringer of an important price reversal, and that's why traders keep an eye peeled for spikes. But sometimes a spike is just randomly generated by rumors and market silliness. The spike turns out to be an anomaly. The top example in figure 7-2 shows such a case. The spike low suggests that some people panicked and were selling so much that, and at such a frantic pace, that buyers got a bargain at abnormally low prices. But panic was misplaced. The next day, the price resumed its uptrend and its same normal high-low range. The spike was just noise. Maybe the panic sellers believed a rumor that the buyers didn't hear or know was false, or perhaps the sellers were deliberately trying to break a support line, as described in Chapter 10. Jack Schwager, in his book Technical Analysis, writes that the return of prices to a previous spike extreme means a failed signal. The bottom spike example in figure 7-2 is in contrast to an important bar named a key reversal, because over the next few days, the price proceeds to make lower highs and lower lows, signaling a trend reversal. Commentators today make a big deal out of the key reversal bar and say that after a spike low, the next bar opens over the spike bar close and makes a new higher high, and then closes below the previous day's close. In practice, you don't need a new higher high, you just need the series of lower highs and lower lows. And it can take more than one bar after the spike low to confirm the reversal, because the confirmation point is at the close surpassing the spike low. In fact, a key reversal bar can be an ordinary bar and isn't always a spike, but when you see a spike, always ask yourself whether it might be set up for a pending reversal. As the spike is occurring, you don't know where the low is going to come until after the bar is completed, and obviously you can't exit the trade until then. In other words, in the next trading session. You still don't know what bars will ensue, but you can make note of the spike low after it forms and keep in mind as a benchmark for a stop, even if the bars that follow the spike retrace some of the down move as they do in figure 7-2. Okay, you seldom know whether a spike is random or meaningful on the day that it happens, unless there is specific news, a news event that everyone knows about and that dominates the headlines. All too often, you find out the cause of a spike only afterwards. You may not know the meaning of a spike until afterwards, but you can still use spikes right after they appear. All right, so investigate the environment. Sometimes you do know when a spike is a hairbringer of a major directional change because you know what shock caused it. Trust the close. As a general rule, you're safe assuming that the close is the most important part of the bar because it sums up the sentiment of the day. To see the usefulness of the close, take a look at the two examples in figure 7-2 again. Continuation spike defined in the top chart showing a spike low. The close is near the high. The wider high-low range and the lower low are a worry to be sure, but the position of the close near the high trumps those worries. And a key reversal day, the bottom chart in 7-2 shows three components to worry about. Not only the wide high-low range, but also the lower low and close near the low. All right, tip. A conservative trading tactic is to order your broker to sell the security if the price falls below the low of the spike day over the next 2 or 3 days. This method is plain old crowd following. Everybody can see the same spike low, and many will have sell orders at that level, and you should too. The bar following a spike is often an inside day. Other times, the following bar has a new higher high, only a few pennies above the spike high, and a close lower than the spike bar close. Neither bar is helpful. They're simply inconclusive, and you have to wait for additional evidence to get guidance on how to trade. That's it for today. Tomorrow we'll do getting gaps. It basically goes into gaps, very detailed. Advantages and disadvantages with gaps. Reversals. And how to use the trading range as a tool. As well as determining the meaning of a range change. All right, cool. Thank you guys for joining. See you next time.